This is Colin Cattell with Palisade Radio. Back on the program with us today is the publisher of the Daily Gold, Jordan Roy Byrne. Jordan puts out a weekly market update on the metal sector through Palisade Radio each week. You can catch that by visiting palisaderadio.com or thedailygold.com to get those weekly insights. Jordan, thanks for coming back yet again.
Colin, thanks for having me. It's my pleasure.
We last interviewed about 3 months ago, and at that time you voiced concern, along with some other analysts, that gold's technical patterns could indicate a move to $1,000 an ounce. And a lot has changed since then, and it's forced you to potentially reconsider. Comparing gold to the US dollar, foreign currencies, the S&P, what are your feelings on the metals today?
Well, my feelings on the metals today are, and what we've seen in the last several months, are looking at gold against foreign currencies. That view or that relationship to gold has been quite strong in favor of gold, especially in the last couple months. Now, it had some strength for most of 2014, but it didn't have enough strength where you thought this is going to surge and break out. And that's exactly what happened in the last couple months. Gold was looking like it was in very bad shape technically. It started to break down at the end of summer, and then it had a weak rally into October to about 1250. Then it rolled over again down below 1200, below 1180. And the same could be said for silver. And both just looked like, okay, this is it. They're going to finally plunge to that coming low in the next couple weeks. And then they didn't. They had a reversal, and then they formed a bit of a double bottom in a short-term sense. Not a perfect double bottom, but it was in place, and then we were able to have this little rally until recently. And driving that, I think, is you had, remember, looking at gold, in my opinion, very simply, gold usually follows the inverse of real interest rates. So in other words, if you're looking at real yields, real interest rates, the more negative that they go, or if they're declining, that is very favorable for gold, because quite simply, let's say you have an interest rate of 2% and inflation is 3 or 4%. You're losing money on that currency. So therefore, it makes sense to speculate in alternatives such as gold and silver to a lesser degree. Whereas if interest rates were 4% and inflation was only 2%, there's no point to buy gold in that situation, because you can leave your money in the bank and earn a real return on your money. So now applying that to, as I said, what happened is even though inflation statistically is very, very low and not going anywhere, you had yields plunging, and especially in Europe, in some places, the yields have gone negative. So Jeff Gundlach, the famous bond fund manager, joked that because yields in Europe have gone negative, it makes gold a high-yielding asset. You could say the same thing in Japan. So because of yields, and especially in those places, not just declining, but really plunging at the end of the year, that's what gave gold a really good bid and quite a bit of strength in those markets and against foreign currencies as a whole. And that's why recently gold against foreign currencies hit a 21-month high. And essentially what that means is if you're applying that to gold in US dollars, then gold moved above 1,500, at least if you're using the US dollar scale and applying it to those other markets. So, and that is also and interestingly, what was happening with those yields, of course, that is very bullish for the US dollar, but bullish for gold at the same time. So that's why we saw both rising together. And it's interesting because if we had this interview 3 or 4 months ago, and I'm sure if you talk to any other analyst, they would tell you, if you said, I know the future, I have a crystal ball, and we're going to see the US dollar is going to surge to 6 or 7 year highs, everyone, including myself and probably you, Colin, would have said, well, gold's going to go to 1,000. If the US dollar is going to surge, there's no way it's going to bottom here and suddenly turn around. It's definitely going to 1,000. So, but of course, that's not what happened. And if you go back and look at gold's history, which I've done very often, gold has if you're looking at its major bottoms, such as 2008, 2000, 2001, and then also 2005, also 1976, gold usually bottoms against foreign currencies first before it does in U.S. dollar terms. So what has happened in recent months is a very good sign for gold. Obviously, it's not out of the woods yet. One thing is, you mentioned the S&P 500 or the Dow, I forgot which, but gold against equities has not broken out yet. It did get a little bit of a bump in the last couple months, but that's something that hasn't broken out yet. I know we'll talk more about that later, but that is one thing that if gold would have broken out more strongly against global equities and U.S. equities, I think we would have seen gold be able to move above 1,300. But so there's still some money going into the stock market. Like I said, I know we're going to get to that later. To me, that kind of explains what happened in the last couple months and why we didn't get that plunge below 1,100.
I was going to ask you about the peculiar state of the US dollar and gold rallying at the same time because, as you pointed out, nobody would have expected that. But you've explained that perplexing situation very well in that people were rushing away from all the other currencies and the US dollar and gold happened to benefit at the same time. The Dow on Friday just hit a record high. And I know we've discussed in the past that a weakening of the general equities was needed to probably fuel this next bull market in gold. Are you worried if these equities keep moving up, which they very well could, that it's going to take the gas that's fueling this small gold bull, is it going to take it away, and are things potentially going to fall back to deeper levels in the bear market?
It's a good question. I guess it's some kind of a worry. That correlation, I think, is well intact if you're looking at it from a long-term perspective. In looking at U.S. equities, they're clearly breaking out the Dow, the S&P, as you mentioned. But, I have a chart up looking at the HUI and looking at the S&P 500. If you look at September, they both kind of corrected together. Then they both rallied together when the Huey had a rally at the beginning of November. Then the Huey made a double bottom. The S&P has been consolidating. So at least if you go back to the end of the summer, there hasn't been a strong negative correlation. And I read something from one analyst who I follow and who covers precious metals and macro things, and he was saying that there's a possibility if we see the equity market go into a kind of a final rally or blow off mode that you could see commodities and commodity equities advance or rebound in tandem with the broad equity market. Remember, the commodity sector, I don't have the percentage in front of me, but it is a part of the overall equity market. And we can also bring in the U.S. dollar, which has been, I know I'm getting a little bit away from precious metals and precious metals miners, but the U.S. dollar is, as some people have seen from my work recently, is essentially the third most overbought that it's ever been in its entire history, which since it floated was 1971. So the third most overbought in over 40 years. The other two times were in 2008 during the financial crisis, and then when the U.S. dollar made its ultimate peak, which was in the mid-80s. I don't have it in front of me, 1985, 1986, I think. So now, does that mean that the U.S. dollar bull market is over? Not necessarily, but it means the dollar is really, really overbought. Sentiment is extremely bullish, and it's more likely than not for much of this year we're going to see a counter-trend move, and that's going to be very favorable for the commodity sector. And also, I would imagine precious metals to some degree, even though they've been rallying with a strong dollar. So if you look at that, that could be a reason why you could see, at least in the short term over the next couple months, possibly why you could see commodities and precious metals rally with the market breaking out. But at the same time, taking a bird's eye view, we have to keep in mind that clearly there has been a negative correlation here over the last 3.5 years. And ultimately, if we want precious metals to be in a real bull market, we're going to have to see the stock market peak out and underperform. And that's why, Colin, looking at the Huey against the S&P or gold against the S&P, that's why looking at those ratios is very important and very instructive. But I would say, I mean, to go back to what I was saying, if they rally together, then what could happen is they could rally together, and then if precious metals have a really good rebound, maybe they start to correct that later in the year when the overall market starts to top out or starts to break down. And then, maybe it's next year where they start to decouple again. So I know I'm just speculating there, but just to conclude what I'm saying, the big picture, yes, we do need to see the broad equity market start to top out and underperform for precious metals to really perform well and get into a sustainable primary bull market. But if you're just looking at over the next couple months, anything can happen, and any correlation can take place there.
I'm familiar with the chart that you posted, and we're just talking about showing the overbought state of the US dollar. My question, though, is this. Gold and the US dollar rallied in tandem over the past, call it 1 to 2 months. As the US dollar strengthened, gold went up. What's to say that as the dollar pulls back, when this short-term correction happens or long-term correction in the dollar, that gold's not going to pull back with it?
Well, that's an excellent question. It's something looking at the dollar's history, I think there was a time in 2009 where, I mean, at the peak of the financial crisis, precious metals bottomed and the dollar was going up. They were rallying together. And then when gold rallied up to 1,000 and then it consolidated for 6 months or whatever, the first part of that consolidation, gold and silver were correcting. And they were more so they were consolidating, but they were consolidating, and then the dollar continued to get weaker. But eventually the dollar continued to correct and remained weak. And eventually when precious metals had digested those initial moves off the lows, then the normal correlation took hold. So I think it's something we have to keep an eye on. Again, it kind of comes back to what's going to happen immediately and then what's going to happen when you look further out. I mean, hypothetically speaking, if the dollar consolidates for, let's say 6 or 7 months or corrects for 6 or 7 months, that's going to be obviously favorable for precious metals. But the first month or two of that, perhaps we see gold consolidate and not react positively to that, because there has been, in the last couple of months, there has been such a strong positive correlation between the two. So again, I mean, we're speculating here, but there can be a different set of answers for what could happen immediately, and then what can happen when you look at 6 months or 7 months down the line.
Good answer. Shifting gears a little bit, you always talk about bear markets being a function of price and time. And simply put, this means that bear markets take a certain amount of time, say 4 years in terms of this gold bear market, and then the percentage or amount of price drops, so say 40%. But Jordan, we talk a lot about gold. Silver is really the metal suffering the worst bear market in terms of both price and time. What's going on with the silver charts these days? Did it have a similar reaction to gold when it started moving in tandem with the US dollar?
Colin, silver has really been underperforming. And on the day we're talking, it actually had a very strong move, bounced off key support. So that'll be interesting to watch in the days and weeks ahead. But you said it. I mean, looking at silver, I believe in terms of the price decline, second worst bear market ever. And if we did see the low back in I think it was the first day of December, that would be, in terms of time, the second or third worst bear market ever. So, I mean, this has just been a killer bear market for silver. But silver has been underperforming gold. And remember, silver peaked before gold. So the silver-gold ratio in favor of silver, that's something to keep an eye on. We want to see silver performing well. We want to see silver outperforming gold. But at the same time, we've already seen in the last couple of months, gold has kind of been outperforming silver. The same thing happened after the 2008 bottom. Even though silver kind of led that bear market down, and silver's outperformance of gold peaked, I think, in 2007 or maybe sometime in 2006. And it made sense that silver would lead gold back higher, but that's not what happened initially. Gold was very strong coming off the lows, and then once gold really got going, you saw silver really pick up steam. And it looks like perhaps we're kind of seeing the same thing happen again. Again, just to come back to today, really interesting action in silver. It was up 2.9%, rebounding off of support. It'll be very interesting to see going forward if this is a sign that silver is going to regain some leadership or not. Ultimately, I mean, on the fundamental side, we've kind of been seeing more hints of deflation than inflation, and that's something that favors gold far more so than silver. Ultimately, silver is going to outperform when inflation expectations rise, and of course, the markets always lead those types of events. So if we do see silver outperforming gold, that's a sign that inflation expectations are starting to rise. On the other hand, if we stay mired in this kind of deflationary view of the markets, then silver might continue to struggle. But all in all, the price action will continue to lead the fundamental developments and tell the tale. And looking at silver, it peaked just below 1850 in January. Again, really nice rebound today, and we'll see what happens. If silver can move above 1850 sometime in the next month or two, that would be very bullish. I think looking at the monthly charts, 19 is such a key level in a long-term sense. If silver can make a monthly close above 19, that would be a really strong bullish signal for silver. So silver, because it can be a potential leader, is something to keep an eye on. Gold has, that's one thing. One thing in the last 18 months or so. I mean, we have seen strong moves at times from gold and then the gold miners, but silver has always been the weakest. So if silver really starts to lead the next move higher, that would be a very, very bullish sign. But then again, it doesn't necessarily have to for the bottom to be in. I just think that if silver outperforms and regains leadership, then it's a indication of the bull market really starting in earnest, because in a metals bull market, that's what you should see.
Speaking of bullish signals and resistance points, I want to ask you a question regarding your work as a technical analyst, and I'm sure many of our listeners are wondering a similar thing. When you observe a chart, what do you most closely monitor that might indicate the beginning of a bull market or any major move in any sector?
Well, it's a great question, and it's so hard to define, really, because, for example, with gold, I mean, gold closed at about 1228 today, and some people were saying it needs to close above 1400 or even 1500, which you can't really dispute. But then the problem is, if you wait for that, you're giving up more than $300 of upside. So it really depends on the market. But one thing I just want to mention is the 400-day moving average, which is also the 80-week and the 200-day moving average. Just going back over the last 15, 20 years and looking at a number of markets, that moving average has just defined the primary trend so perfectly and so well that it's something I keep an eye on. And looking at, I mean, I've posted some charts recently. If you look at the HUI or the GDX and you use a 400-day moving average, or if you're looking at a weekly chart, you use the 80-week moving average, dating back to the end of 2011, it's done a really good job of marking support and resistance. And essentially, the gold stocks have really not traded above that moving average, since the very end of 2011. And in the last couple weeks, they rallied up to the 400-day. They didn't quite touch it, but they got very close. And now we see the 400-day moving average is starting to flatten for the first time in many years. And obviously the miners are trading below that. But if we see the miners take out that moving average and remain above the 400-day or the 80-week for a couple weeks, to me, that would be a really, really bullish sign that a new bull market has begun. Again, other people have other definitions, and that's fine. Looking at gold, the 400-day moving average also works. Gold has been below that moving average since looking at the chart, it appears since the very end of 2012 or early 2013, gold hasn't been able to touch the 400-day moving average throughout this bear, but it did in the last couple weeks, and it did rally above it. Now it's gone back below it. So the 400-day moving average is something I really like to keep in mind. And also, we mentioned it before, but looking at precious metals against the S&P 500, because there's been the strong negative correlation for the last 3.5 years, that's also something to really keep an eye on. And if we see a strong breakout in favor of precious metals against the S&P 500, then that in itself would be a very strong sign that a new bull market has begun. So those are just the things that I'm looking at and keeping in mind that are pretty simple to follow. And also, when I'm looking at individual stocks, gold and silver companies, I like to use that same moving average, and it just does a really good job of showing which companies have already bottomed and are in an uptrend, and which companies are struggling to get to that point, essentially recapture that moving average and trade above it, and go from the point of being in a questionable trend to a clear new bull trend.
In conclusion, I'm looking for a bold prediction, Jordan, a headliner for this interview, if you will. Is the bear market in mining stocks over as far as you're concerned? Or if not, how sure are you? 80%, 90%? What's your feeling?
Well, it's really tough to say, Colin. I mean, I remember in almost 2 years ago or 18 months ago, and after that crash we had in 2013, I was thinking there's no way this is going to keep moving lower. And looking at the stocks that I follow, I mean, I have my own indices, and there's a fair amount of stocks that I track that actually bottomed at that point in the middle of 2013, and then a whole lot bottomed at the end of 2013. Yet still, if you look at GDX and GDXJ, they made new lows in October 2014. And so with respect to GDX and the Huey Gold Bugs Index, they made a very strong double bottom, and that's a much stronger base of support than the miners had at their previous bottoms, a much stronger base of support. And also at that point, they were obviously a lot more oversold. They were the second most oversold in a long-term sense that I've ever seen them been. I mean, the most oversold they were in history was in the weeks leading up to that bottom in 2000. That was the most oversold they've ever been in history. And so several months ago at that low, perhaps the second most oversold ever. I just think when you factor that in, you factor in the strong double bottom, I think it's more likely than not, maybe I could put it at 70% that they have bottomed. I mean, I think the worst is over. I mean, looking at the strong stocks, they've already bottomed. And just a couple other things I'll mention. These companies, for the most part, are based in Canada or incorporated there. And so much of their costs are in Canadian dollars. And we've seen the Canadian dollar get very, very weak. So the gold price in Canadian dollars is at a 21-month high. So that is a big benefit to these companies. And secondly, look at the gold against oil ratio. Energy costs can account for up to 25% of mining costs. There's been a huge change there that really favors miners. And just a last point on that, this is most bullish for Canadian companies that are operating in Canada and also exploring and developing their projects in Canada. Those companies are really in a good prime spot here because the Canadian gold price is very high, because the Canadian dollar is weak, and then you factor in the oil, working up there in the Great White North, so to speak. There can be, the energy costs of these projects can be higher. So just looking at those factors, those are some slight fundamental changes that we've seen in the last couple months that the miners didn't have. They didn't have these benefits at the previous lows. So looking at all those things, I do think the bottom is in for the miners, and it'll be very interesting to see what happens in the weeks and the months ahead, because they're not far from breaking above the 400-day moving average. And in fact, if you look at some of the Canadian indices, they've already broken above. Some of them have already broken above their 400-day moving averages. Now, they haven't held that yet, but again, because of the weak Canadian dollar, a lot of these miners, again, priced in Canadian dollars, they're showing a lot of strength. And so, again, it comes back to the U.S. dollar. The U.S. dollar strength, which has been huge, is a reason why GDX, GDXJ haven't been able to break out yet. And so if we get that pause or a correction for several quarters or for most of the year, that could be another factor that helps these companies, or the miners as a whole, I should say, break above those 400-day moving averages. So those are some factors to keep in mind.
And for our listeners who enjoyed this interview and want more insight from Jordan, we have a Palisade Metals Market update that goes out every week on PalisadeRadio.com. Jordan's kind enough to put that together, and he puts detailed charts up and walks you through the charts in video form. That's definitely something to go check out. Go to thedailygold.com, sign up for Jordan's free newsletter and his paid subscription. And on that note, Jordan, thanks so much.
Thanks for having me, Colin.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw material. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?